This is our chapter on income taxes. I believe that it is an easier chapter than some. We really just have to memorize the way in which we do a reconciliation. And the reconciliation is between net income, we call it pre-tax accounting income, and the tax form, which is the tax form, the amount which is showing up as a really a taxable income sort of a number. So it's not, you're not reconciling net income on the income statement to net income on the tax form exactly. You are reconciling the pre-tax accounting income, which is net income before tax, which is on the income statement, to the amount that you are going to pay taxes on for net income. That is what the IRS recognizes as your net income before tax. So you have to reconcile these two items and identify the differences. And then you have to separate the differences into being things that will always be out there, always be differences between those two line items, or those things that somehow go away, they reverse out. And we have to classify those. Then we have journal entry, but there's a standard format for the journal entry. Always we make our life a little complicated though by at the end of each chapter they talk about the exceptions, or we talk about the details and how you handle particular situations. So we'll be doing that again in this PowerPoint. So I think that we can cover most of it, or this PowerPoint, we will cover it all in one setting. It is not as complicated as your chapter on leases. It's not as complicated as your chapter on non-current liabilities. It should go pretty quickly for us. Just a few concepts to understand, and it's really about the setup. So why do we do accounting for income taxes? So you have a tax accountant, and the tax accountant is going to look at tax situations and say, well, we could structure this transaction in this way, and this would be the amount of taxes we'd pay. And if we structured it this way, this would be the amount of taxes we pay. And the tax account is going to plan into the future. And you also know from your tax class, and you should take a few tax classes here as a part of the curriculum. When you take those tax classes, you know there's the tax filing, and you learn how to do the forms, and you learn how that the IRS treats certain items, whether it be for individuals or for companies. So we're going to talk about the company accounting in this particular applications for what we're talking about deals more with corporations. So the tax accountant has to do all those things I just discussed, but the tax accountant also has to maintain accounts in the general ledger to handle the timing differences that occur between when things show up in the income statement and when they show up on the tax statements. So that sort of a thing has to be handled, and it's handled through the general ledger. So you're learning about the financial reporting side to what the tax accountant does. So if the net income is $100,000 and the tax rate is 40%, and when you took accounting 201, you would just normally jump to the next thing and say, okay, I need to record income tax expense of 40,000 and income tax payable of 40,000. In this chapter, you learn that the only time you would do a journal entry like that is when you have no timing differences. That is to say, you are going to be paying taxes, your tax statement income is going to be exactly the same as your net income on the financial statement. This just does not happen. And so we need to teach you the differences that can occur, the things that can happen, and how to handle those. So it might be that we have certain items that we never pay taxes on. We will call those permanent differences. Or maybe certain items that we pay taxes on that don't show up in the income statement. Harder to come up with those examples, but they are out there. And then we have taxes that we pay according to a different type of a schedule. In other words, the tax forms are generally done on cash basis, while our income statement is done on accrual basis. So if the cash comes in today and we are paid early for something, then we are going to have to pay the taxes on it when the cash comes in. But if we're paid early and we haven't earned it, it doesn't show up in the income statement yet because we have to wait till we've earned it. So these sort of situations here are called timing differences because over the long term, the amount of taxes which we pay is going to be the same. It's going to show up the same on our income statements as it shows up on our tax forms. There's just a timing issue where it shows up in net income one year and it shows up on tax forms in other years. And oftentimes, we call this reversing. Oftentimes this reversing happens over a multitude of years. It just isn't the next year when we pay or receive the benefit for whatever the item is. It's not just going to turn around in 2 years. It's going to extend over multiple years. So we start doing a type of a spreadsheet to show this. And there's an account called income tax payable. Income tax payable. And as I was talking about this net income and the tax rate 40%, and I said it would be income tax expense $40,000 and income tax payable $40,000. Well, that's the income tax payable account I'm talking about. When we have these differences, whether they're permanent or they're timing, it means that that journal entry is not right anymore because the amount of taxes we pay is not income tax expense. It could be higher, it could be lower, because again, the taxes aren't paid based upon the income statement. The taxes are paid based on the tax form. So what we're going to talk about, and I have it separated a bit when you look at the pages if you're doing an online class. I break it really after the third learning objective, and then I go into the ones at the bottom. The important things are, I think, 1, 2, and 3, and understanding how to do that setup. You also need to know 6, though, along with that, because when you have a deferred tax asset or a deferred tax liability, and when I work through problems, sometimes I'll call them DTAs and DTLs. Whenever you show those on the balance sheet, you net them. So you net your assets, you net your liabilities. You'll have multiple ledger accounts, but it shows up as one line item on the balance sheet. And they're always classified as non-current. We just talked about income tax payable. The payable designation means that there's going to be a check cut. We've understood that now for a bit. If there's a receivable term, that means you're going to get cash in, right? So it has a payable, so you know it's going to be cash going out. That is a current liability, and it's current because it's the taxes you owe this year. There are possible ways that you can extend that payment, and you can create it so you can do things to avoid having to pay it right away. But for our purposes, we are going to call it a current liability, and we're going to assume that you're going to be paying it within the next year. On 5, we're talking about net operating losses. This is when you have a situation where you haven't been so profitable. Instead of having a tax situation where you have income, you actually have losses. And if you have losses, then you don't have tax expense, you have tax benefits. And of course, you want to get those benefits. You want to either get the cash in right away or you want to apply it in the future. So the loss carry forward is carrying a loss forward so you get to use the benefits in the future. On 7, the last thing we really talk about here is what happens when you have something that you're carrying as a deferred tax asset and you think the IRS might challenge you on it and how that will get recorded. I'm really most interested in 7, that you understand the concept, that you understand the concepts of how it's done versus the details of how it's done. And 1, 2, 3, and even 4 or 5, 6, I'm really interested in you working through problems as well. So deferred tax assets, I call them DTAs, and deferred tax liabilities are DTLs. A deferred tax, if a deferred tax liability is here defined, I think when we work through the problems, you'll see that you really don't have to know all these words to memorize this to understand what a deferred tax liability is. A deferred tax liability means that you are going to have to pay something more in the future. That's what it really means. A deferred tax asset means that you are going to get a benefit in the future and you're not going to have to pay as much in the future. And these deferred tax liabilities and deferred tax assets have a starting point. And the starting point is when you come to the knowledge that your income, your net income, and the net income for tax purposes, your taxable income, is different. When that happens, you have to say, do I have a deferred tax asset or a deferred tax liability? Or the alternative is to say, it's not anything that will either give me a liability in the future or a benefit in the future. It is something that's just always going to be there hanging, and that we call a permanent difference. So the permanent differences don't show up in the deferred tax liabilities or the deferred tax asset accounts, only those that are due to what we call timing, and it's the timing based on the net income being accrual and the tax form being cash basis. Tax expense is another account we use today and in this, and tax expense is going to show up on the income statement. And you are very familiar with this because it'll say net income before tax, and then it'll have a line for tax, and then it'll be after tax net income. So this is the tax expense is a line that goes in between those two items before you get to net income. When we do this, as I said previously, you used to think of it as tax expense, taxes payable, and that was one journal entry. There was a debit, there was a credit. When we do tax expense, it's easiest to think of this as a plug figure. After you've figured out what to record in deferred tax assets and deferred tax liability, and you have figured out what your current tax liability, how much your cash you're going to have to pay is, then you plug it in as a separate item, which is a debit, and it is tax expense. Here's an example, and I realize I've kind of cut off the top of it here, but it's a deferred tax liability from revenue reported on a tax return, and it shows up in the tax return after it shows up on the income statement. So the first event that's going to trigger you having either a deferred tax asset or a deferred tax liability, and we'll talk about that, is the income statement, because here it shows up on the income statement before it shows up on the tax return. So we have a reconciling item in that initial year when it shows up on the income statement. So this company has pre-tax accounting income in 3 years, and these 3 years it's 100 million. And then they have an additional item in 2016 of 40 million from installment sales of property. In this case, when they have the sale, they should be recording revenue, right? And that's what they're saying. It shows up first on the income statement. However, they are not going to get that revenue in all together today because it's going to be recorded as a receivable that's going to go off their books in future periods of times. When the receivable gets collected, that's when the cash comes in. That's where it shows up on the tax return. So this is considered a timing issue, and it originates in the first year, and in the first year is the year in which they actually made that sale. And I assume it's a sale of land. Yes, it's a installment sale of property. So you do a schedule, and you're going to do the schedule including 2016, 17, and 18. And you're going to recognize, you're going to notice here that it's a temporary difference. And the temporary difference, this is what I need to say, is going to be recognized in 2016. And it's going to show up as an item in 2016. I want you to see you start with the pre-tax accounting income statement before tax. That's what that is. And in the first year, they say you have 100 million in pre-tax accounting income, but you have an additional 40 million. So let's start plugging in some numbers here. And you notice the first one then is really 140. For simplicity purposes, they kept it at 100 million for 2017, 2018. In the first year, we do not pay taxes on the installment sale. And the assumption with this problem, I have to tell you, is that there's no cash coming in from installment sales in 2016. So when we do our taxes, it's appropriate for us to subtract out the 40 million that were installment sales, because they are not going to be taxed when it shows up on our tax return. So might be helpful to think of it as accrual basis in pre-tax income, and taxable income is cash basis. Perhaps that's helpful. And so the cash, the cash income in this case is 100 million. Now this is really simplified, and I'll say that here because there's only one item that's a difference. And I think I'm trying to drive home to you that there's multiple things like this happening for a corporation. So when they do their work in 2016 and they record tax expense and they record income tax payable, I'm going to say, well, what is income tax payable? Can you look at this? Can you tell what it's going to be? Well, it's going to be the rate of taxes times the taxable income, not accounting income, but taxable income. So they're gonna pay a payable here based on taxable income times a percentage. But when they do this work, you see there is an item that's between the top and the bottom, and it's a negative. Whenever you have a negative in the first year, and they're calling this originate year or origination year, whenever you have a negative there, it means you're going to have a deferred tax liability. Whenever you do something like this And to go between pre-tax accounting income and taxable income, you have to add something, so it wouldn't be in parens, you'd be adding it. You are going to have a deferred tax asset. So when you look at this, there is one item, there is a deferred tax liability. Now the amount of the deferred tax liability is not going to be $40 million. It is going to be the tax you pay on the $40 million. So they're going to tell us what the tax paid is going to be paid on the $40 million. In this instance, they tell us the enacted rate is the same for all these years as our current tax rate. And our current tax rate is 40%. So when we have to pay the tax on it because we get the cash in the future years, and what years do we expect it to come in? We expect it to come in 2017, 2018, the cash is coming in. When this cash comes in, we are going to be taxed on it at 40%. So this, I believe, is going to be a 4. This is going to be 12, right? And those are the amounts which we are going to have to pay in the future as liabilities. They're liabilities today, amounts to be paid in the future relating to the installment sale. Now, if we're going to pay that in the future, we should then today record it as a deferred tax liability. So I said the first one is going to be 4, the next one is going to be 12, and 4 and 12 is, right, 16. Now you could have shortcutted it, and the shortcut would be obviously to take the 40 times the 40%. But I want to caution you right now that the rule we use is that you need to put it in as a deferred tax asset or as a deferred tax liability. You are making it, you're recognizing it, you're originating it, whatever words really help you there, in 2016, but you need to look at the rates that you see are currently enacted. Enacted means law. What's the law for the next years? And if the law for the next year is 40%, then they go in at that same rate. However, if the law was 25% in one year, 35% in another year, you're going to have to do the math. You're going to have to multiply 10 times 25 and 30 times the 35 and come up with a combined number to put in as your deferred tax liability. The way they do the schedules here is they create it here and then they subtract it on a separate line. I like to show that the thing completely goes away. So what I tend to do is I tend to put the 10 up here, the 30 up here, and then if this is minus 40, this is plus 10, and this is plus 30, then we can see that it completely reverses. At the end of 2018, we will have a 0, right? You can do it this way, the way the textbook does, if you like, and when you look at it this way, you will also see that 40 minus 40 plus 40 is 0, and that in the end, your pre-tax accounting income for all the periods combined and their taxable income for all the periods combined is equal. So another way to say that is if you have a deferred tax liability, we need that deferred tax liability to completely remove from the books by the time 2019 starts, right? And we also, if it was a deferred tax asset, you'd want the same thing to happen. We want it to go away. And the liability or the asset, the deferred account, needs to go away in a way in which it shows up on the tax form. So as you see in this one, we don't take 20 here and 20 here. We are saying that the cash is coming in as 10 million here, 30 million here, and so we are going to use that, and we're going to take, you see, the most of the deferred tax liability is going to go away here in 2018. When we do this and we do our calculations, the enacted rate for the current year is 40%, but it also happens to be the rates that are going to be enacted today that are the rates for 2017 and 2018. So what we do now is we are going to create a combined deferred tax liability that really needs to have a beginning balance of 16. Now they show 0 here. What they're saying is before this event there was no deferred tax liability for this group of transactions, because it really is a group of transactions, and it originates in 2016 and it reverses in 2017 and 2018. Sometimes people look at this a little bit differently, and they talk about basis and tax basis and financial basis. And okay, that's fine if you want to do that sort of approach. You could say that we had a receivable at the end of 2016 and that the receivable got paid off in 2017 and 2018. If you want to look at it that way, that's fine. And I think what they are telling us in the way they did this particular T account is to say that prior to 2016 we had nothing there, and during 2016 we need to create a deferred tax liability, not for 40 but for 40% of 40, or 16. Liabilities always begin at their journey with us, if you will, as a credit, and up here when we do this reconciliation it shows up as a minus. And sometimes I say this is a minus, minus is bad, liabilities are bad, and to make that connection. And pluses are good, and pluses would be assets, right? So if you can make that connection, and some students say, well, this is bracketed, and credits tend to be bracketed, so that's a deferred tax liability being created, and that helps them. But you have to remember, just go based upon whether you add or subtract in this reconciliation to get from this number to this number. If you subtract it, it's a liability. If you add it, it's an asset. So the journal entry which you're going to do for that first year is a familiar form, should be to you. It has an income tax expense, and the income tax expense is a plug number that you put in last. The first numbers you need to do are to calculate your income tax payable. It's 40% based on 100 million. So that's 40. That is the amount where you're going to have to cut a check. It's a current liability going to have to be paid off in the next year. The deferred tax liability, we calculated that earlier, said it was based on the enacted rates that we believe would be there for 2017, 2018, based on our current law. Calculated it at 16. Tax expense is a plug number. The general format, the way I do this journal entry, is I usually put my deferred tax liabilities and deferred tax assets before income tax payable, and I write income tax payable last. So if you see some journal entries I've done, the order of the last two may differ. This is a simplified version because we are assuming there's only one timing difference which exists, and there are no permanent differences. When we look at this, then as we go through time, we're going to see 4 is going to go away in the first year after it's recorded. So 2016, we put the 16 on our books. 2017, the reversal was for 10, and 40% of 10 is 4, so 4 is going to go away there. This means you're going to have a debit to deferred tax liability when you do your journal entry in 2017. So when you create the deferred tax liability, you're going to credit it, but when it goes away, you are going to systematically do debits to deferred tax liabilities. And it's not an equal amount, though. It's based on the cash flow. And this is the type of journal entry. I would say with this journal entry, again, you're being simplistic, because I'm sure within that period of time, a large corporation would have multiple deferred tax assets being recorded in 2017 and multiple new deferred tax liabilities coming on the books. So you'd have not just this deferred tax liability debit for 4, you'd have multitudes of deferred tax liabilities credited. You would also have more than one deferred tax liability that was reversing. So they have the one that started in 2016. You could have more in 2016 that are going to reverse. You could have more that date even back prior to that are going to reverse. So this is a simplified way of looking at it. Again, we are going to pay taxes. Now, we're not going to pay taxes based on net income. We are going to be paying taxes based on our tax form. So you have to go back to your reconciliation. You have to look at the bottom and say, what is taxable income? And then you have to say, what is the tax rate for that particular year to calculate it. The plug number in all this is income tax expense. It's just a number that gets put there to make the journal entry work. 2018, the final 12 goes away, and you get a similar journal entry to what you had in 2017. I know you're tempted to say net income is 100, and so let me take 100 times 40% and get 40. The problem you get into in using that approach is when you have permanent differences, that approach is not going to work. So far, we have only had temporary differences, those differences which reverse. So what I'm saying here then is tax expense is based on pre-tax accounting income only when you have just temporary tax differences. When you start getting into a situation where you have the permanent differences, like we're going to be doing with one of our problems, it's not going to work for you. So you're better off thinking of it as a plug number when you record tax expense. There are a bunch of different illustrations here. It says illustration types of temporary differences, and the purple will create tax liabilities and the blue ones create deferred tax assets. So you have a situation where you're using the installment sale, and that's the first bullet over here in the purple in the top left square. Installment sales of property. Whenever we do this, as in our last problem, it creates a liability, and it will be subtracted from your income statement amounts because you would have included it in there as revenue, and for your tax form on that first originating year, your taxes would be reduced because of that, because you didn't get the cash in. There are also examples that it could be the opposite direction. And this is in the blue down here, and I'll just go through one of these. And that is rent collected in advance. So if you collect rent in advance, it does not show up in your income statement as a income item because you have not done anything to earn it. And generally with rent, we talk about passage of time. So time hasn't passed, you don't get to record rent revenue. However, when the IRS looks at it, the IRS is going to ask you, what's your cash coming in from rent? And you're going to say it's included there because you had cash coming in. So this is going to be the opposite situation of the situation for installment sales, because with this one, you are going to get the cash in early and you're going to have to pay taxes on it now. So that creates a deferred tax asset. The expenses and losses to look at here, one of them that's very familiar to students, I guess, is this accelerated depreciation. And I hear certain students call this MACRS or MAKERS. I've heard both used by students depending upon, I think, where they studied and what their teacher uses. But this means that that expense item on the tax form is very high because you accelerate the rate of depreciation. And what that does is it reduces taxable income in the first year. And remember, your perspective needs to be in the originating year, originating of the difference. So the year that they bought this item and the year that they start depreciating it, you're going to see taxable income low relating to this item, and you're going to see that net income is going to be high. Okay, so there's a problem there. But when we look at depreciation through time, we realize that depreciation through time should be equal to the total depreciable amount. So in intermediate 1, even in financial reporting 201, you looked at an asset, a fixed asset, you deducted the salvage value, and then you said you had to spread that depreciable base over a number of years. It's the same thing happening here. That depreciable amount is going to be greater for tax purposes in the first year than for other years. And on the income statement, you might do it straight line and do the same amount every time. If I ask you what's the total effect over time on your taxes and your income statement, you'd say it would be the same. And we could add it across on the schedule and see that. But the difficulty is that in the first year you see a difference, and it's going to reverse out over time. So the first year is when you're going to see that you need to create a deferred tax liability. Shortly before the end of 2016, Coulter makes an installment sale, generates $400 of before tax income, recognizes for accounting purposes when the sale is made. Well, that's GAAP, isn't it, guys? And it says recognize income for tax purposes. And I'm not sure I like the word recognize. I try to get away from it. But for tax purposes, they're going to have to pay taxes on it when it gets collected. So you're going to have to pay taxes on it later, but today today it's showing up in your income statement. So the income statement needs to be, the pre-tax accounting income somehow needs to be reduced to get to what your taxable income is. And if it's reduced, it's a deferred tax liability in your setup. You can put this in that setup form if you want to, or you can simply write down the number, and you can say that it starts with 400 in the pre-tax number, and then the taxable will be nothing in the first year. So the amount of the reconciling item is going to be 400, and the liability, though, be careful, is not going to be 400. It's going to be based on the tax rate. And most of the problems will have just one tax rate given. However, if there are multiple, you are going to have to figure out what the tax is going to be on that for multiple years. So again, I don't quite understand this, except they're saying that it is originating in this year 2016, and that's why we are recording it. And the journal entry at the bottom says you have tax expense and you have a deferred tax liability. I would say about this journal entry here is they don't give us information which tells us what their taxable income is. If I had taxable income given to me, I could multiply that times the tax rate to figure out what my income tax payable would be here. They don't give it to us. And so the assumption they're making when they happen to do this journal entry, I don't like it that they gave it to you here, is that I guess we have zero or something. There's no tax payable in this. I think you don't need this journal entry, and you shouldn't trouble yourself about the journal entry. Instead, you should just talk it through as I did. Now, here we start with a deferred tax liability of 150. What does that tell you? It says that something happened probably 2015 or even before 2015. Really do not know that caused us to have a deferred tax liability on our books when we started this period of time. It says started 2016 with this deferred tax liability. At the end, we identify future taxable amounts of 500, and we have a tax rate of 40%. And we know that taxes payable for the year is going to be 120. So you're going to take some of this information and you're going to plug it in there, and you're going to try to figure out what your journal entry is going to look like. So let's talk our way through this thing. Well, we know that our deferred tax liability, it says future taxable amounts. It doesn't say future taxes to be paid. It says taxable amounts. So this is going to be taxable at 40%. 500 times 40% is going to be 200. So they want us to have future, we're going to have deferred tax liability on our books at the end of the time period of 200. So they're saying, what do we need to do to make it 200? They're saying, let us credit it for 50. That apparently needs to be done. Then we also have a situation where taxes payable needs to be 120. So if taxes payable is 120, the deferred tax liability needs to be credited or increased by 50. Then we know that the other thing that's in that journal entry is tax expense. Tax expense must be 170. And there is a good part about this problem because it teaches you tax expense is the last thing we do. It is the plug in the journal entry. And so that's what it's driving home. It's the plug. So if you only have temporary differences, then you could have used net income. If you have permanent differences, there's an issue that you need to work on. This is you can read through this if you'd like, but when we work the problems, it all becomes quite apparent. Here we have 2 million installment accounts receivable, and of course they're going to pay taxes when the cash is collected. And so if we have accounts receivable on our books, then it also means that that is our future amount of cash flow that we anticipate from this. And in the problems, by the way, I want you to assume that all receivables will be actually turned into cash and that you will not have any bad debt or any other issues. So the 2 million will be coming in as cash, and they want to know what the tax liability should be, and the general rule is it's the amount times the rate, and the rate is 35, so you get 700. Deferred tax assets, these are going to happen when you're doing your reconciliation and you have a plus item. So you have to add to pre-tax income to get to taxable income in that reconciliation. So this is a problem. I'm going to jump into this deferred tax asset problem. They give you, like in our previous problem, how much of the accounting income you're going to have for all those years. And then they're going to say that in 2016, when they gave you the 70 million, there was actually 30 million in there that you have actually had a cash situation with it, but it needs to be deducted for tax purposes in the future when it's actually paid. So when you do accounting, you do an accrual basis accounting, and you're going to accrue warranty expense when you make the sale, but you're only going to pay the money out for warranty expense as the customers come back with the defective products. Again, I'm going to assume that the defective products is going to be the same as their original estimation when they did the accrual. So we have then this 30 million in expense. So it shows up as an expense, reducing net income for this time period, and it does not reduce taxable income. So there is going to be a situation where we need to put a plus in between to get us from pre-tax accounting income to taxable income. Does this go away? Yes, it should go away. And they're going to simplify again by making it 40% each year. So the originating year is the year when we accrued for warranty expense. And when we do our taxes, we do not get to deduct the expense of warranty expense on our taxes. So we have to pay taxes on more. And we end up having to pay taxes on the 100 million, and we're going to pay 40% on that. And I think that's 40 million, isn't it? So you can tell by looking at this that our income tax payable, a current liability, is going to be 40 million in that first year. The warranty expense item is again, this is a positive, this is not bracketed, becomes a deferred tax asset, and you do not record it for 30. You record it at the amounts of which you expect it to reverse, and that is based on the tax rates for 2017 and 2018. And in this particular situation, they're simplifying, it's still 40%. So 40% of 30 is 12, and it's going to be half each year, so 6 each year. So I think I said 12, and I think I said 40. So I ask you now, what is tax expense in your journal entry? You could surely answer the question. And hope we get it here. There we go. And so the deferred tax asset is 12 as a debit, because we always create an asset as a debit. And our tax payable is a credit for 40, and the net amount is income tax expense, which is 28. The reversing is going to be done, and I'll just give you a quick look at the journal entries here, because you need to remove the deferred tax asset by crediting it each year by 6. You should do income tax expense as a plug, just so you get used to doing it that way. You should go down to taxable income and multiply your taxable income on that reconciliation times the tax rate in each one of the years to come up with your income tax payable for each year. In this case, it's always 40. And when you look at this, you notice that the 12 goes away here, here, and it becomes 0, and that's what we would want it to do. Opening balance, they're bringing home again the fact that we are originating it in 2016. They want to say this is the start, and this is the way they do it in the T accounts, and that's what they're trying to drive home. The warranty liability, then, as we could look at receivables for installment sales, we can look at liabilities, and we could say that initially you have a liability and that the liability is expected to go away in 2017 and 2018. So apparently the products they sell in 2016 have a 2-year warranty on them, and they should be expected to, after that, then the customer has no claim against the company for anything they bought. So after 2018, any warranty on the products they sold in 2016 is basically worthless. The customer can't bring it back. Again, the assumption here, and I will never ask you about this, the assumption is that your estimate is accurate and that in 2017 and 2018 the actual warranty expense which you have in terms of cash outlay is going to be that 30, right? It's going to total up to the 30. So that is an assumption that's made to simplify our lives, and as complicated as this class is, I'll take it, won't you? So when you go across, if you were to add completely across, you would find that all the effects completely reverse in the next year, which is our definition of a timing difference, and our definition either of a deferred tax asset or a deferred tax liability. News Month has 10 million in deferred revenue of subscriptions. That means that somehow they got the cash in, but they haven't done anything to earn it. So when you look at these situations, you say, well, which came first here? Did the income statement effect come first, or did the cash come first? And in this case here, they got the cash. So they got the cash in, but they have not done anything that would cause it to show up on the income statement. So they're asking us, how does it show up? In previous problems, they've said it's a deferred tax liability, and then they say, what's the number? Or they say it's a deferred tax asset, and what's the number? And here, you really need to kind of look at it as a setup issue. So in the top line where you have pre-tax accounting income, should they show any income for these subscriptions? Okay. How about for the taxable income? How does it show up there? And so you work through that and you do a little type of a reconciliation, and you have to kind of make up some numbers when you do it to figure out that you need to go from the one value to another value, and do you add or do you subtract? This amounts to a deferred tax asset for the total amount of 3.5 based on the 10 million. So the explanation here is in the future they will recognize accounting income. They do not have the accounting income now, but they got the cash in. So if you are doing a fake little schedule, you would say pre-tax accounting income is 0, but on taxes, what will they have to pay the taxes on? And the taxable amount in this year is 10. So we'd be 0 something to get to 10 million. And it's going to be a plus 10 million. But that's not, you know, now you have a deferred tax asset. You don't know the amount of the deferred tax asset, and the deferred tax asset is the appropriate tax rate times the 10 million, and it's 3.5. So that's the way you work it through it. Valuation accounts are used when you have deferred tax assets. You don't use them for deferred tax liabilities, only deferred tax assets. So you created these deferred tax assets, you have them on the books, and now something changes. And this change causes you to see that something is not quite right, and you think it's more likely than not that you won't get the total amount. So it's very careful. We have to be careful about the words. What we're saying is more likely than not, that number that I have recorded as a deferred tax asset is too high. Okay? And if the number looks too high, and the definition again is more likely than not that it needs to be reduced, it needs to be, a valuation account needs to be created that attaches itself to the deferred tax asset account, and it shows as a credit. And the debit is simply going to be to income tax expense. So I look at this as a separate adjustment that needs to be made when you go back and you look at your work and you realize, or you see, that there is a problem with this deferred tax asset, and it might be overvalued. It might be overvalued. We may not get the full benefit. And the rule is more likely than not that some portion or all of the deferred tax asset will not be realized. Okay, so the cash benefit in the future is more likely than not to be reduced. Then you should create a valuation account or have a valuation account associated with that particular deferred tax asset. This is a kind of a complicated problem. You don't necessarily need to know how to work this problem. I just want you to understand that when you look at these T accounts, they have a deferred tax asset of $100,000 and they have a valuation allowance of $100,000. So they're starting this particular year with kind of a statement that says, we put a deferred tax asset on our books, and we believe more likely than not that we won't be able to get any benefit out of that deferred tax asset. So again, it is more likely than not that this deferred tax asset has a value of 0, and it's on our books at 100. So it got hit here to be reduced. So we were not overstating an asset. So we had a separate journal entry that took it down, and it was to this associated account with that deferred tax asset called the valuation allowance account. Now we go on into 2017, and we need to show a deferred tax asset of 150, but we think our valuation allowance should be such that we only have 20,000 in the net value. So they're asking us questions about how do we adjust these balances and what do we do? And they want us to combine all this into one journal entry. And so that's what they're asking for here. And they say our tax payable is going to be $300,000. So income tax payable credit is $300,000. We know we're going to have to do something to the deferred tax asset to increase it to 150, and we need to make the difference between the deferred tax asset and the valuation allowance account to be 20, and that's what this problem is about. So I'm going to go down here and show you what happens here, because they want this and this to net to 20. They're going to have to put 30 here as a credit. They're going to have to put 50 in here as a debit to get this to 150. And then they are going to have a payable, taxes payable, and I said I usually put this on the bottom line, and this is income taxes payable, and it's 300. So this is back to what I originally has told you best to do is you plug tax expense. It's a plug number that makes the journal entry work. We have total amounts of debits of 330,000. We have a total amount of credits of 330,000. So figure out what you need to make it balance, and you do that. Permanent differences are not the result of timings. They are just differences that come off the top. So when you have a permanent difference, you're going to put it in there in the reconciliation, and you're going to show it, but it doesn't reverse out. It's just a one-line item that occurs in the originating year. It doesn't show up in the next years. It's just the originating year. And because of that, it doesn't reverse out. You don't create a deferred tax asset or a deferred tax liability. Because one of the premises of deferred tax assets or deferred tax liability is that in the end they become zero. And in their timing and they go away. So you would never put a permanent difference in there. When the tax changes, tax law changes, you have to go back and examine your situation. What happens to all your deferred tax accounts, and should they go up or should they go down? And instead of going back in the past and saying, I made an error, you did not make an error. It is really like a change in estimate. You don't have to make a restatement. You don't need to go back and say, oh, my financials were wrong in that year, my tax expense was wrong because I thought the tax rates in 2025 were going to be 25%. Now they're 35%. No, no, no. You don't have to go back and do anything different. All you do need to do, though, is you need to get your liabilities and your asset accounts in their proper values, because when you do the financials, you need to be truthful in your financials. And any difference there is going to go to tax expense. So an astute accountant is probably going to go through every one of those separate deferred tax asset and deferred tax liability accounts and say, what should the balance be? And they're going to adjust them by a certain amount, be it a debit, be it a credit, whatever. And the net that's needed to make the journal entry work is going to be tax expense. Now, it could be income tax expense credit. It could be income tax expense debit. I don't know, but you're going to do that. Now, this is separate from when you record your income tax payable and your debit to tax expense and your debit to your deferred tax assets and your credits to your deferred tax liabilities for those originating ones and the reversing bits and all that. This is separate. You're just going to, as soon as you find out that the tax law has changed, you are going to go through all those accounts and adjust them. Net operating loss carry forwards, and also there are net operating loss carrybacks. So you have a year, you did not have a good year, you lost. You have a financial loss for the year. You do not have tax expense in a year when you have a loss. You have tax benefit. And so many times when we have problems in managerial accounting or in our other classes and they talk about net of tax, you'll see, well, this is an expense, and you still do it net of tax. And when you do the tax, you actually are reducing the expense, right? And when you have revenue, you're actually reducing revenue. And when you have net income, you reduce net income. So a loss is actually reduced by the taxes on it, which seems counter, doesn't it? But that's the way it is. So you wouldn't call it an expense, a debit. You would call it a benefit or a credit. Now, the question is, when you have these, then you do your financials and you have the line item, you have a loss plus income tax benefit to get to net income. So you have an idea of what that amount is going to be. Of course, you'll have deferred tax assets, deferred tax liabilities, all that business. The question is, what do you record to be your debit? And it depends on what we are going to do. If we are going to get the cash in and claim it against cash payments we have made to the IRS in the past 2 years, we can ask for a refund of our taxes for the past 2 years, in which case we record it as a receivable. That is called a net operating loss carry back. This says up here at the top, carry forward. So then we would have recorded a receivable. If, however, we want to take it and claim it against the taxes in the future, we're going to be nice to the IRS and we're going to say, next year when I have a profit, I'm not going to pay you any taxes. So you'll just use this and you'll apply that in the future when I have a profit. That is called a deferred tax asset, and that's called a carry forward. Now, the problem with the carry back is if you didn't pay that much cash in, they're not going to give you the cash back. You're only going to give you your cash back to the extent that you paid cash into the IRS in the past 2 years. So you end up taking it forward. Because of the time value of money concepts, I'm going to tell you you're better off going back and trying to get that cash and getting a check cut from the IRS or a direct deposit in your checking accounts. You want that cash coming in today, so I would go a carry back first, and then I would carry forward, because the carry forward only has a beneficial effect on your cash flow when it's time to pay the taxes in the future periods of time. Okay? An assumption of a carry forward also is that you're going to have net income and you're going to owe taxes in the future. So there you go. Again, if you're going to get cash in, they're going to pay you. You call it a receivable. If you're going to wait and apply it to future payments, you call it a deferred tax asset. Now, if you think you're not going to be able to use the deferred tax asset, and that expression is more likely than not, you're going to have to do a valuation on it. Prior to 2017, they asked us to go through every one of our deferred tax accounts and figure out how much of it's current, how much of it's non-current, or figure out is this related to a current asset or a current liability, and if it was, you call the whole thing a current account. Now, we should classify all DTAs and all DTLs, deferred tax assets, or deferred tax liabilities, as non-current, and put the valuation account in there. And the other thing is, when you do your financial statements, you need to net your DTAs and your DTLs and figure out if your tax situation is a net DTA or a net DTL, and put it as one line item for that. If we're not sure that the IRS is going to accept what we want to record, and we're gonna think of it as benefits, what do we do? And we can go through, and this is when we have an item that we're not really sure what the IRS is going to say about it. We assess probabilities. We think we'll get away with 10% probability we'll get away with 8 million. A 20% probability we get away with 7 million, and a 25% probability we get away with 6 million. And they're going to say, well, what do we record? I mean, most of us would say 10% times 8 plus 20% times 7 plus 25% times 6, and we come up with some other number to total over 100% and get a estimated value, right? And kind of a mean calculation. But no, of course, we don't do that with GAAP. In GAAP, we say, when do we get to the 50% threshold? If there's a 25% probability that we will collect 6, and there's a 20% probability that we'll collect 7, and a 10% probability that we'll collect 8, you need to add down and you need to come up with a cumulative probability that you come up with 50%. So when we look at this, there is a 55% cumulative probability that we will have 6 million. So let us use the 6 million. Now you only had to be at 50%. So we can only record 6 million. If we could do it so that we would get a number that is exactly a cumulative probability of 50%, so if I could come up with some number between the 6 and the 7 that would get me exactly at a cumulative amount of 50%, then I could record more than 6 million. Okay, so probably what I would be doing if I was doing this and I was wanting to record tax benefits, which is going to show up as an asset in my financial statement, and that'd be a good thing, I would go back and I would try to come up with exactly 50%. Because here I know 30% is 7 million, and I know 55% is 6 million, but that tells me probably 50% is going to be somewhere between 6 and 7, right? So I could probably have recorded more as a benefit if I could come up with exactly that 50% number. Okay.